Anton, thank you for having me on. I look forward to talking the markets with you and hopefully sharing some knowledge with your listeners.
Yeah, great. Thanks for being with us. Why don't you give us a little bit of a background of what you have been doing before you ventured into real estate, right? I think you also have some interesting background on the tax side too, and then what you have been recently doing on the real estate side.
Okay, yeah, definitely. After undergrad, I worked at UBS Investment Bank for a few years as an analyst, and I love my job. And I decided to get my master's. And when I was in grad school, that's when the market tanked. And essentially, I realized I couldn't trust the equities market. I couldn't give people advice to invest in mutual funds or stocks, bonds, and I had absolutely zero control of it. And that made me do a lot of internal processing and thinking. And when I graduated, I decided to go the consulting route. And I worked at a company that when I showed up, they put me in sales and use tax consulting, and honestly didn't know what it was. And it was great. I learned a lot of things from a tax perspective, from sales and use property taxes, even fuel taxes. And I spent about a decade in the tax realm or tax industry consulting. Then I was at an energy company. But one of the things it did was, luckily, it made me realize I didn't want to do that for the rest of my career. And probably back in, I guess in 2009 is when I started to venture into real estate. I was a limited partner on a couple of deals. And then I did close to 20 single family homes. And then since 2016, I've been a GP on multiple deals. We're in the process of closing, which would be my 13th GP acquisition or development.
Yeah, that's great. Obviously, you started out right at the right time in 2009, right? When the opportunities were plentiful. We wish we could say the same today, and we certainly can touch on that a little bit later. Now I think you, based on what we know, you have been now the latest focus is on a deal that you soon will be closing is in Florida. But before that, I think you also have been involved in quite a bit of projects in Texas. So maybe you just can give a little bit of a background there too, right? So just our listeners understand your deep knowledge also on the development and asset management side.
Yeah, yes. Most of my projects have been in Texas, but Florida will be the fourth state that we've invested in. And as you know, especially the larger markets in Texas are very competitive. And most of our acquisitions or developments are in secondary and tertiary markets. We like the yield. We like it not being as competitive from an acquisition standpoint. And we can go in and we've been able to provide our investors as good or possibly even better returns than some of the people that are buying in Austin, Dallas, Houston. And I've been able to build out a network with a couple of property managers where they manage kind of across the country. And that's given me a lot of comfort to go into some of these markets that are a state or several states away, because they're the boots on the ground. I have a comfort and familiarity with them that I'm definitely talking to them every day. Every week we have calls, but I'm not necessarily having to be at the property every day. And in my experience, I've worked with 7 or 8 property managers, and they all have pros, they all have cons. And now we're kind of whittling it down to a few that feel like have risen to the top of the heap. And now we're focusing on assets that they're able to manage and help us gain the most, extract the most value from.
Very good. So these property management companies, are they more large national firms that you prefer to work with rather than just local firms? Is that the kind of the strategy?
One's a large national firm, and then one is more of a regional firm. They're based in Atlanta, but they do have operations in some of the southeastern, I think 5 southeastern states. And they were uh, initially a broker, then an owner, then a developer, and now property manager. So they've seen the entire spectrum, and they can give us insight that some property managers might not be able to, just because they haven't actually owned a or the other property managers haven't owned a property like they have. And their team has been with them for a lot of them for 15, 20 plus years. So there's a lot of continuity that we can leverage their resources and skills that have helped the process in the Atlanta market and now in the Florida market. I think a lot more seamless than it would be if I had to go out and start interviewing local property managers that I had no experience or rapport with.
Yeah. Okay. Very good. Uh, Now it's interesting that you mentioned that you've moved kind of away from Texas because of the high prices and the competition. And your deal that you're going to close in the near future happens to be in a high price market, certainly on a per unit basis, which is in Orlando, where I would say, even compared to Dallas Fort Worth, the price per units or price per doors still seem to be pretty high, right? They might be at the level what you would pay in Austin, but you probably still pay more typically than what you will pay in Dallas Fort Worth market. So what made you feel comfortable to go into a market where even for a 60s, 70s property, you may pay around 200, 180 to 200,000 plus per door, compared to a market where you may be able to get it for 150, which is still extremely high, right? In Dallas Fort Worth, or in the upper 180, 190 in Austin. So what made you decide that, yes, the price per door is really steep, but we are still comfortable to get into such a market?
Yeah, and I'm still looking in Texas, but it's just turned out that the last few deals have been out of state. And what made me comfortable going in with this property is it's a 2017 vintage. So it's newer product. There's not that many issues that we have to correct from a deferred maintenance standpoint. And we're getting at a price point which to some people it sounds crazy, but we're paying 200,000 essentially per door for it. And in the same Orlando MSA, we were looking at properties that one was 210, one was 180. Some of the new builds in Orlando are going anywhere from 235 to 275. So we feel like we're at a really good basis. And even in Dallas now, some of the newer properties are trading. I was talking to one broker and he was saying anywhere from 220 to 255, 260 a door. So pricing on the newer builds are pretty comparative. But one thing that I like is Florida doesn't have the crazy property taxes that Texas does, where it's hard to model out an insurance, even though Florida is on the coast and it's in Hurricane Alley. Essentially, they haven't had the storms. Some of the insurance providers haven't pulled out. Like, we got our insurance premium back less than a month ago on our Texas portfolio, and it increased by 36%. That just kills the bottom line on any deal. And you can't model out a 36% property insurance increase. So even though the price per unit might be a little bit higher or a little bit more than what we're seeing, the overall return we think is going to be better, just because the expenses are a little bit lower than what we would be paying right now in Texas.
Mm-hmm.
So, and not trying to make like a Texas versus Florida, only conversation, but as you thought about this particular investment, maybe a little bit richer, you see opportunities to really capture the return for your investors. On the back end, what are kind of some of the drivers that you think, that Florida provides that makes your exit more probable, or give you comfort that this is the right price and you're going to have a successful exit for your investors?
Yeah, that's a great question. And I don't want to compare Texas to Florida or to Atlanta. They're all different markets, but there are similarities. Everybody knows that people are moving to Texas, to Florida, to Georgia, to Arizona. So we have that population growth that I think is going to continue. I'll be honest, before we seriously looked at this deal, I looked in Orlando, but I kind of shied away because I was afraid of just the tourism industry and its boom and bust. And then with COVID, I thought it was going to take a massive impact. And the more research I did is there's a lot of Fortune 100 and 500 companies in Orlando, and it's more white collar jobs than maybe most people believe. And our property, it's actually north of Orlando. So we're 40 to 50 minutes probably away from like all the Disney, Epcot, all the tourism. So our employee base doesn't even make up any of the workers that would be at Disney. And since it's a newer vintage and a Class A, it goes for more of the white collar workers. And another thing that Orlando has for it is they have some large universities, and they're getting an influx of young working professionals and talent every single year moving in, and a lot of them are staying. Obviously, some will migrate after they graduate to find a job, but a lot are being able to stay in Orlando. And over the last 17 years, Orlando's job base or employment base has grown by 45%, which I think that's just going to continue in the future.
Yeah, that's a great point, right? So I think that's what a lot of people really do not understand, how diverse the economy is in Orlando, right? Or greater Orlando,
Yeah.
right outside of that amusement park bubble there, right? So there are many, many more economic drivers. And I would say certainly we don't know how it looks medium term, but short term, that market, Florida in general, certainly benefits from less density, right? So I think even college graduates at this point, they may not be that inclined to move back to a major city, and I think the problems certainly haven't gone away, right? So, like when we look at Freddie now reducing the COVID reserves just as of yesterday, based on our recording we have today, they still have pretty significant concerns in certain locations, and the major locations where they're concerned about are all the dense gateway cities, right? So I think also for graduates and generally white collar employees, they think twice once they study and graduate in a market like Orlando or have a job opportunity, whether they really want to move back into a major big city. I think it will come back. It will just take a number of years. Right? That will definitely benefit you guys with that property.
Yeah, that's what we're hoping. And I know with COVID, it had a shift of the working culture, and obviously most people are working from home now. And we'll see how long the swing it takes to go back, and when people start going back to the more densely populated urban areas. I think eventually people are going to go back to work, because you have to have that company culture, you have to have camaraderie. The younger staff, for people early in their career, they need that connection with the senior leaders, with the senior managers, just to be able to help grow their career. I'm not sure how long it's going to take for them to go back to working full time or be in the office 60% of the time or whatever, but it will happen eventually.
Yeah, definitely. You brought up a good point, right, when it comes to taxes and insurance. I think Orlando, you definitely have the benefit that it's further inland. Insurance rates right along the coast are pretty tough to swallow. In Florida, as it is in southern Texas, and obviously we have it virtually anywhere in Texas because of tornadoes and hailstorms further north. Now, when it comes to taxes, this is a really good point, right? Everyone looks at price per door, but no one really discusses the ongoing operating costs that one has. And as we know, taxes make up a big chunk. And other than Florida, another market that a lot of people always felt that's overpriced is Arizona, right? But there again, you have a much better control over your tax situation, right? So you do not get that massive hit just because the necessity decides that now the value for all the properties in that particular submarket need to go up, right? So it's a very good point that you made there. Yeah.
Well, thank you. And yeah, I think more and more people are starting to focus on it. Everybody's getting squeezed from a price point. So you just have to look at the OpEx expenses. And I know some are controllable and some aren't, but the more you can save on the OpEx expenses, the more you're just going to add value. Because if you increase rent by $1 or save $1 on expenses, it's the same thing. So and with technology coming more and more to the forefront, I'm hoping we'll get more efficient, just from an entire expense standpoint. But like another thing that Florida has from a tax perspective, which is nice that some people don't know about, is if you pay early, you get a 4% discount. So you can even factor that into your tax payment amount, and it just helps you save that much more. I would assume most people take advantage of that. If they don't, they're just throwing away money, but not everybody understands that.
Sure. Yeah. Excellent point.
So Sam, just kind of leveraging off your comment a little bit earlier off of insurance, that spike that you saw, where do you find that your team, as you're looking at investments, like, where do you think you have the opportunities to, like, maybe your strengths to execute when you do get a spike like that? Because obviously on the front end, you're underwriting deals, maybe you're passing on some that you think are too rich because you don't have that operating cushion for these types of eventualities. So not so much kind of what's your secret sauce? Like, where do you think your strengths are with your team that when these do occur, you've got some, trick in your bag that you're able to focus on to still kind of maintain those returns? Because that type of hit, like you're saying, to the P&L, I mean, that can have a significant drag for a window of time to be able to try to just have rents naturally lift. What are some of the solutions you try to bring to situations like that?
I don't know if it's a secret sauce, but I do feel like we operate our properties well. And outside of all but one, my oldest property is a 96 vintage, and most of them are in the 2000 teens. So we do have a newer product, so our expenses are going to be a lot lower than a 1970s or 60s vintage. But I think just constantly staying on the property manager and managing it from just a continual daily basis of how we can improve. And some properties you can improve almost immediately. Like we were able to go in on this Atlanta deal and we've pushed rents in 5 months more than $200 because it was horribly mismanaged. But on other, especially the ones that we've owned for a few years, we can't do these massive sweeping changes at a drop of a dime. So I think it's bringing in technology, like I mentioned. I think it's adding, luckily Texas is a great market for this, and there's some pricing elasticity that the consumer will take, and we can add different fees. Now that some of our insurances went up, before the insurance went up earlier this year, we implemented some different fees that are almost standard in the Texas market that aren't in other markets, such as a common area maintenance fee, or one of our properties, we dug a well and we've been supplying them with well water. Now we're turning it into actual water system where we can bill back for 100% of the water they use and all the costs associated with it, instead of just basically rubbing them the water. So it's just looking at each property and seeing how you can optimize it. One, we were able to charge a convenience fee that in that market it took it, and I tried in other markets and it didn't. So it's just always testing different pricing that we could implement, trying to, I mean, in some projects we'll go and do kind of like the green project where you implement new toilets, LED lighting to save electricity costs. Just almost we'll try any way to reduce the expenses. It doesn't always work out, but just constantly testing the market and asking. I mean, we send out links to residents on probably a monthly to quarterly basis, asking them what they like, what they want to see improved, and getting their feedback, which provides us a lot of good information to just make their lives and the community that they live in better.
Yeah. You mentioned price elasticity. I think that's particularly in the A-class space, right? If you provide true value, residents have the ability to pay for it, right? So that's where good or excellent property management plays a massive role, right? If you have a great property with great service, and even though you have to pay for it, those tenants tend to be willing to pay for it, right? And obviously in the C class, that's a little bit of a different story. In B class, it's still a little bit more challenging, but particularly on A class, you have that ability if you're just above the rest, right?
Yeah, and I mean, we haven't tested this out, but we're planning on doing it on this new deal in Orlando, is putting in electric vehicle chargers and seeing if that's an amenity that the residents want. As we were, well, I took a trip to Houston with a friend, and he has a Tesla, and we had to stop multiple times, and it was honestly kind of frustrating because it extended the trip a couple hours. And I was thinking, like, if the resident lives on a property on site that they don't have a charger, that's just an added inconvenience that they have to go fill up however every 300 400 miles at a charging station. But if they had it at their house, essentially, maybe that's something that brings them back, and maybe they'll recommend it to their friend to stay here. So for the cost of actually installing the charger, it's not that much, and hopefully we'll add, if we can get a few more leases, it was worth it.
Yeah, definitely. That really brings up the question: how many of electric vehicle owners are renters, right? Because that's definitely is a challenge when you're a renter to charge your vehicle overnight, right? So that's kind of the business model. Everyone who has an electric vehicle, you plug it in at night when you come home, and then you're fully charged in the morning. But if you cannot do that easily, it's very hard to own a vehicle, even if you just drive 30 or 40 miles per day, because it's very hard to charge even within a city outside of your own residence. So it would be interesting to know what that percentage is, and maybe you're able to carve out a niche there with a sufficient number of charging stations, so that all the Tesla owners and all the others, and maybe now the F-150, future F-150 owners, will be all flocking to that property, right? So that's certainly a value add element there. John talked about secret sauce. Now, I think the question there also is, what was your secret sauce to win that deal, right? So as you know, pricing in Florida and Orlando is pretty crazy, right? So we have seen, as I mentioned earlier, C-class properties that are trading at mind-boggling numbers that are, depending on the submarket, 150,000 plus. And you're able to capture a virtually brand new Class A property for a pretty reasonable price, right? So how were you able to achieve that, competing with other players? I would say obviously it's not a very big property, but it's still relatively close that even institutional players would also play in that sandbox. So how were you able to win that deal over others that were undoubtedly competing for the same property?
Yeah, that's a great question. And to be honest, part of it was luck. But I think also with that, we had the preparation to pounce on the opportunity. We were in Florida the week that it started to be a marketed deal, and it came out, and we toured it. I think the second day it hit the market, and we asked the broker, "Can we preempt it?" And he's like, "We'll see." And luckily, we had a relationship with a broker. Our property manager that we're going to bring in, they had a relationship with a broker, so they were able to give us a good word. We had a phone conversation with a seller, and a lot of the things they were looking for in a buyer, we met their criteria. And I think the final piece of it was the seller. They're a development company, and they were focused on 4 or 5 other developments that were frankly more than double the size of this one. So I think they kind of took the eye off the ball. They had their loans maturing on July 5th, and which is coming up really quickly. And we basically told them, hey, if you go through the marketing process, you aren't going to be able to close on time, or nobody's going to be able to close in time. So I think there was a lot of confluence of events that helped, but just us taking those steps, because there's a lot of deals I'll ask the broker, can we preempt? And nobody's ever said yes. So we were kind of surprised, but we were grateful, because every deal we've went through the marketing process on since last September, it's been bid up $1 to probably $3 or $4 million. So we felt like we're coming in at I won't say a good price point, but we're coming in at a very fair price point, and maybe even a good price point compared to some of the new vintage comps in the area. And that was just the relationships we had been working and building over the last few years, I think paid off dividends.
Yeah, that's a great story, right? It's kind of surprising that even major developers take the eyes off the ball, right? Knowing that you have a maturity, you need to do something, and somehow it's still sitting there until they realize, oops, we need to do something.
Yeah, and through that first conversation, and then the seller, I was pleasantly surprised, but they showed up during due diligence, and through the conversations we've had, we've just realized how mismanaged that property was. And they had 3 on-site managers in less than a year. And it just showed they were kind of out of sight, out of mind, and had their mindset on bigger projects and fish to fry.
Yeah. Well, it was great for you, right? That you were able to get in there, and that the preemptive offer was accepted. So congratulations on that. Right?
Thank you.
So thanks again. It was really great to have you on today, Sam. How can our listeners reach you? Obviously, you have investment opportunities, but also just to get not just to get on your list, but also to hear from you how, if someone has a question, how you were able to evaluate the market in Florida, right? So since you're out of state, but we're still able to win that deal. How are our listeners able to reach you?
Yes, definitely, Anton. Thank you for having me on. And listeners can go to my website, batescapitalgroup.com, and you can fill out information there, or I have some free resources that they can sign up for. Also, you can call my cell phone at 972-855-7654. And I'd love to talk real estate or potential investments with anyone.
Yeah, great to hear. So now your cell phone will blow up. Hopefully not in the middle of the night.
Yeah, I sleep is important to me, so I silence it.
Yeah,
I'm open most of the day.
Okay, great. Thanks again, Sam, and good luck with your closing in Orlando.
Well, thank you, Anton and John. It was great talking to you, and look forward to speaking to you again.
Yeah, same
Thanks,
here.
Anthony.